Today, New Zealand wins the Bubble Prize. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news with a distinctively Australian flavour. Today I want to look at housing markets around the world and specifically look at where it's hot and where the bubble is biggest. And in fact, New Zealand will win that prize. But before I start, just two very important announcements. The first is we've just crossed over 60,000 subscribers on YouTube. And I want to say thank you very much to each of you who've subscribed. I really appreciate it and your support. And also to let you know that because of the spurious number of comments we're getting from non-subscribers, especially relating, for example, to spam crypto scams, in about a month's time, I'm going to change the settings so that only those who have subscribed can actually make comments on the channel. Now, I'm not doing that to throttle free speech. I'm just trying to do it to clear out some of the rubbish. So if you haven't subscribed, please do so now, partly to show your support for what I'm doing here, but also simply to reflect the fact that we can make this community a much cleaner place to make comments. Now let's go back to today's post. World equities are now clearly in a bear market. And in fact, you could argue that the most excessive speculation has already been washed out of the system. Those warning of bubbles in Bitcoin and other cryptocurrencies and meme stocks, or indeed growth tech stocks, have all been proved right. But if there's one asset that should come under scrutiny, it's real estate, because of course that is propped up by massive flows of credit. With a double whammy of higher rates and the lasting effects of the pandemic, it's interesting to look, for example, at office property. And in fact, the US office property real estate investment trusts, or REITs, are slightly lower now than they were 20 years ago. They're actually almost back to the lows during the worst of the pandemic in 2020. And if you look more broadly at housing, rates in the mortgage-backed bond market in the US have been surging, as you'd expect, of course, with the move in Treasuries, while the rates actually offered to US borrowers went even higher. A typical 30-year mortgage rate is now just around 6%. And that's approaching the pre-crisis highs of 2006. So the world economy, which is already contending with raging inflation, stock market turmoil, and the brooding war, is facing yet another threat, in my view, the unravelling of the massive housing boom. And as central banks around the globe rapidly increase those interest rates, soaring borrowing costs means people who were already stretching to buy property are finally reaching their limits and beyond. And the effects are being seen in countries such as Canada, the US, and New Zealand, as well as Australia, where once hot residential real estate markets are starting to turn really cold. Now it's a sharp reversal from years of surging prices fueled by rock-bottom mortgage rates and government stimulus, along with a pandemic that popularised remote work and sent home buyers on the hunt for bigger spaces. In fact, a recent analysis by Bloomberg showed that 19 OECD countries have combined price-to-rent and home price-to-income ratios that are higher today than they were ahead of the 2008 financial crisis. That's an indication that prices have moved out of whack with fundamentals. So taming frothy home prices are going to be a key part of many policymakers' goals as they seek to quell the fastest inflation in decades. But as markets shudder from the prospect of a global recession, a slowdown in housing would create a ripple effect that could deepen into an economic slump. Falling home prices would erode household wealth, dent consumer confidence, and potentially curb future development. And of course, animal spirits are typically tamed when people are faced with higher repayment costs on an asset that's losing value. And also property construction and sales are huge multipliers of economic activity around the world. So the danger is that business and financial cycles might be turning down simultaneously, which could lead to longer-lasting recessions, said Rob Suberman, head of global markets at Nomura Holdings. A decade of QE has fueled frothy housing markets, and we could be entering the other side of this soon as housing affordability is stretched and debt service ratios could rise sharply. So, such a scenario would, of course, really slow bank lending as the risk of bad loans increases. It would choke the flow of credit that economists have thrived on for, well, a couple of decades actually. And in the US and Western Europe, the housing crash that precipitated the financial crisis in the Northern Hemisphere hobbled the banking system, governments, and consumers for years. And indeed, in the UK, for example, people were in negative equity for at least 10 years post the global financial crisis. Now, maybe a 2008-style collapse is unlikely because, some would say, lenders have tightened standards and housing savings are still robust, and many countries still have housing shortages. But on the other hand, mortgages are a lot bigger and home prices are extremely high, driven by very, very low interest rates. And so moves up from this point will be very significant and actually pretty dramatic. Now, of course, they also say labour markets are strong, which will provide an important buffer, but unemployment may start to rise. Lower property prices could well have a direct effect on consumer spending and indeed the whole economy, as typically real estate makes up a significant part of households' wealth, said Tully McCulley, head of Asia Pacific Economics at Scotiabank. Nevertheless, as household balance sheets in many major markets remain healthy, I'm not particularly worried about risks related to house prices in the world economy. Well, that's quite a common view, but I must tell you that view, in my mind, is slowly dissipating, not least because the buffers and the wealth effect is not equally shared across the whole of the market. Indeed, there are many marginal borrowers, as we'll see later. But the risk of a sharp drop in prices is clearly greater when there's a synchronized global tightening of monetary policy, said Nirav Shah of Bloomberg Economics in London. In fact, more than 50 central banks have raised interest rates by at least 50 basis points in one go this year, with more hikes expected. And in the US, the Federal Reserve recently boosted its main interest rate by 75 basis points. That's the biggest increase since 1994. And we also see that housing markets in New Zealand, the Czech Republic, Australia, and Canada rank among the world's bubbliest and are particularly vulnerable to falling prices. Portugal is especially at risk in the euro area, while Austria, Germany, and the Netherlands also look frothy. And in Asia, South Korea house prices also look vulnerable, according to analysis by S&P Global Ratings. That report noted risks from household credit relative to nominal GDP, the growth rate of household debt, and the speed of house price gains. And elsewhere in Europe, Sweden has seen a dramatic turnaround in housing demand, sparking concern of a country where debt runs at 200% of household income. Goldman Sachs economists recently wrote a report that signals from home sales typically precede prices by about 6 months, indicating that several countries are likely to see further declines in values. And a substantial cooldown in housing markets is an important reason why developed economies will likely slow, according to economists led by Jan Hatzius. The very rapid deterioration in affordability and large drops in home sales suggest that a hard landing is a meaningful risk, especially in New Zealand, Canada, and Australia, although they say this is not our baseline given current tightness. Central banks, though, are issuing warnings of their own. The Bank of Canada recently said in its annual review of the financial system that high levels of mortgage debt are of particular concern as interest rates rise and more borrowers are straining to pay bills. And the Reserve Bank of New Zealand's semi-annual financial stability report said that the overall threat to the financial system is limited, but a sharp decline in house prices is possible, which could significantly reduce wealth and lead to a contraction in consumer spending. As borrowing costs rise, real estate markets face a critical test. If central bankers act too aggressively, they could sow the seeds of the next crisis. So let's have a look at what's unfolding in a number of bubbly housing markets around the world, and New Zealand is right at the top of the list. If 2021 was the year New Zealand's house price growth reached dizzying heights, with an annual increase of close to 30%, 2022 is shaping up to be the year the music stops, and the abrupt change has left people scrambling. As Bloomberg reports, in March, Jonathan Milne decided it was time to sell a family home in the Auckland suburb of Whananga and purchased a larger house nearby for $2 million New Zealand dollars. He and his wife Georgie were optimistic of a speedy sale and a good price for their old home, which was valued by the local government at 1.8 million New Zealand dollars. But all that changed in April, when the Reserve Bank of New Zealand took aggressive action to tackle inflation and hiked the official rate by 50 basis points to 1.5%. That's its biggest increase in 22 years. It quickly followed with another 50 basis point jump in May and a projection for the rate to peak at close to 4% next year. Milne's house was meant to be sold in May via auction, which is a popular method of home sales in New Zealand, but not a single bidder showed up for the event. What we didn't anticipate was that it would be so hard to market and sell our house, Milne said. We knew that every week that passed would knock another $100,000 off the price. At the end of last month, they accepted an offer that Milne describes as dramatically below the government valuation. And economists expect New Zealand house prices to fall about 10% this year and maybe eventually drop as much as 20% from their late 2021 peak. And while for many homeowners that's a small decline compared with the massive equity gains in recent years, there's likely been a broader set of effects. ANZ Bank forecasts subdued consumer spending due to a mixture of people feeling poorer because of falling house prices, the impact of higher rates on cash flow, as well as higher food and energy prices, according to Sharon Zollner, the bank's New Zealand chief economist. There are going to be household buyers who've just entered the market in the last year or so who started off with a mortgage rate of 2.5%, and all of a sudden they're rolling off onto a mortgage rate closer to 6%, said Jared Kerr, chief economist at Kiwibank in Auckland. There is going to be some pain for sure. Now, over in Canada, the housing market there has turned so fast that some buyers are losing money on their properties before the sale even closes. People are actively trying to get out of deals, said Mark Morris, a Toronto-based real estate lawyer, who cited one example where a property's assessed value came in at 200,000 Canadian dollars less than the purchase price agreed to only a couple of months before. That left the buyer willing to give up their $100,000 deposit to avoid closing, he said. I'm called several times a day by various people who feel that they've paid too much. Such cases are cropping up after Canada posted its first national home price decline in 2 years in April, followed by another drop in May. Though so far the pain has been concentrated around the markets which saw the biggest pandemic run-ups, Toronto and its surrounding regions, the strains are already starting to spread to formerly hot markets around Vancouver too. Like in other countries, the turmoil in Canada's housing market is being caused by an aggressive campaign to raise interest rates by the central bank. The benchmark has already gone from 0.25% at the beginning of the year to 1.5% today. With even higher rates expected, some economists say home prices could fall by as much as 20% in the hottest markets. It's a drastic change in a country that saw prices rise by more than 50% over the 2 years since the pandemic started. With prices rapidly outpacing wage growth, some buyers' hope of entering the market came from low rates that are now jumping. It's the marginal buyer who's supporting current valuations, so that could mean significant impact in the housing market, said Mathayo Asiu, Deputy Chief Economist at National Bank of Canada, who said home prices nationally could fall by as much as 10%. Will new buyers be able to afford those prices at these rates? And over in the US, the S&P Case-Shiller Index of houses in 20 major cities topped in 2006 and had lagged behind inflation ever since until earlier this year. New York and Miami, which were both the subject of particularly excited action during the property bubble 16 years ago, has also seen prices surge. But the key point is that prices have taken off. Rates in the mortgage-backed bond markets are surging, as would be expected given the move in Treasuries, while the rates actually offered to US borrowers are even higher. A typical 30-year mortgage rate is now around 6% and approaching the pre-crisis high of 2006. That's uncomfortably similar to the conditions that triggered the global financial crisis. Mabel Melendi could tell the housing market in Cape Coral, Florida was slowing after a week went by and she still hadn't received any inquiries or offers on a newly constructed home that she listed in mid-April. Just 3 months ago, she received a bid on a similar property within 3 days of putting it on the market. But after 3 price knocks, dropping the asking price down to $425,000 from $510,000, and more than 2 months after the initial listing, she was still looking for buyers in mid-June. One offer that came in over Memorial Day weekend fell through after the buyer couldn't qualify for a large enough mortgage. Most of the people don't qualify for what they used to qualify for beforehand, Melendi said. Mortgage rates have increased this year at the fastest pace on record, in records dating back to half a century, according to Freddie Mac. The average rate for a 30-year loan reached 5.78% last week. That's the highest since 2008. That's led to price cuts for both builders and existing home sellers as demand rapidly cools. Almost 20% of US home sellers cut prices in the 4-week period ended May the 22nd. That's the most since October 2019, according to the brokerage Redfin Corporation. The share was higher in some markets that became hot destinations during the pandemic for people seeking more affordably priced homes. In Boise, Idaho, for example, 41% of sellers dropped prices in April. In Cape Coral, it was 1 in 3. Sellers are realizing that prices may not keep rising at the same pace they did previously as buyers are increasingly squeezed, said Daryl Fairweather, Redfin's chief economist. Prices are going to have to come down to match demand, she said. After rising by an estimated 18% in 2021, US single-family home prices are forecast to grow by a more moderate pace of 10% in 2022 and 5% in 2023, according to Freddie Mac. It's a pretty significant slowdown, but coming from scorching hot house price growth, said Len Kiefer, the company's deputy chief economist. A shortage of homes for sale and pent-up demand from people seeking more space, along with millennial buyers getting older and starting families, means prices nationally should still be able to tread higher, he said. Still, the effects of slowing demand are reverberating through the real estate industry. Redfin and Compass said last week that they will lay off employees after the sudden cooldown in the market. And over in the UK housing market is starting to slow after 2 years of historic growth. As part of pandemic measures, home buyers were exempt from a stamp duty tax on properties valued up to £500,000 between July 2020 and June of last year, sending prices escalating even further and making housing seemingly detached from the rest of the economy, said Tom Bill, head of UK residential research at Knight Frank. But now the Bank of England has increased rates 5 times in recent months, with more hikes expected to come. That may portend a cool down in real estate for the rest of the year, with more supply becoming available as homeowners rush to beat declines in values, Bill said. Already approvals for new home loans have dropped to the lowest in almost 2 years, and buyer inquiries fell in May after gaining for 8 straight months, according to a survey from the Royal Institution of Chartered Surveyors. House prices in London, although not the country as a whole, are now higher in real terms than they were at the top of the last boom, according to the Nationwide Building Society House Price Index. London housing has benefited from the perception that it offers a haven for Russian or Middle Eastern fortunes, so the downward pressure from here could be severe. People are worried about the economy, about how the war in Ukraine will affect prices and the rising cost of living, says Athesia Beveridge, head of research at UK real estate company Hamptons International. They're more cautious. And the Bank of England decided this week to scrap affordability tests which gauge borrowers' ability to repay their mortgage as at the 1st of August. Now that could increase the risk of first-time homebuyers making purchases they can't afford. Still, areas such as prime London are faring well, Bill said, as foreign investors flock to international destinations and students return following the pandemic. Secondary cities like Birmingham, Liverpool and Manchester are seeing their prices grow even faster than in the capital. As long as the UK is seen as a country with a rule of law, good schools and the respect of private property, money will always flow in, Bill said. Well, for now at least. Now, I'm not going to discuss here again the Australian situation. I've made several shows in the last couple of days on that. But you can see that this issue of bubbly house prices now turning south due to higher interest rates and a slowing economy is happening not just in one market, it's happening pretty much in all Western markets. And of course, that's because central banks are dancing the same tune. But I think the feedback loop between economies and markets is something worth considering. And I also note that most economists are still quite coy to call downside forecasts. So it is significant that Christopher Joy here in Australia is talking about potentially a 30% drop in property prices here. And I think that's probably a more realistic assessment of where things may go. In my modelling, I still run multiple scenarios because it's quite likely that we will see some support to try and persuade people to buy, maybe even loosen lending standards, or maybe even see rate rises reverse later. But if none of that happens, and if the economy continues to spiral negative and inflation isn't caught quickly, then there is significant downside risk to property prices. And meantime, of course, households who are trying to manage their budgets, not least because of the higher cost of living and fuel, school fees, I could go on, means that their mortgage and rental payments are going to be more difficult to make ahead. So this does not augur well in my view, and I think we are going to see the bubble dissipate. And as I said at the top of the show, New Zealand is in pole position, I think, to really experience this first. They started lifting their interest rates earlier than Australia, and we've already seen property prices fall. And here in Australia, where the RBA's only just got their act together, more rate hikes to be expected, and we are already seeing prices sliding. So buckle up. This is going to be a very significant and difficult 12 to 18 months for the property market. There is almost no certainty of price rises from this point. The risks to the downside are increasing. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.